Hello and welcome to Profiles in Risk. This is your host, Tony Cañas, and hopefully you can hear me well enough today because I am on the road at my mother-in-law's house without my microphone. So hopefully my Mac is good enough to catch this. I'm not the main start of the show anyway. So today I have with me Hale Stewart, JD, LLM, Vice President at REcapture Insurance. Hale, thank you for joining me today.
Good to be here.
So what is REcapture Insurance?
Okay. REcapture Insurance is an alternative risk financing wholesaler. We work with agents specifically for larger accounts. We have a minimum of about $1 million to $1.5 million of annual premium for the insured. But once we get to that level, the possibility exists to put together an alternative risk financing program. May involve a captive, it may involve like a layered program, but it's all on A-rated paper or better, and it's typically in higher risk industries. Ideally, what we look for is companies that have a good claims history, solid risk management, who aren't being rewarded by the insurance industry. So we put together a loss-sensitive program with the sole purpose of somehow returning between 25 to 50% of the insurance premium after they close the claims year. That's the short 30-second, well, a bit longer than 30 seconds, but elevator what we do.
I forgot my line. I forgot to say today's episode is dedicated to Lance Wallach.
There you go.
I know is a gigantic fan of anything related to captives and will comment on this video after it goes live.
Sure.
So Lance, thank you for commenting. Okay, so captives. So normally, normally I keep the like basic questions and to kind of to the end. But in this case, captives are esoteric enough that for real quick for our younger listeners or listeners who have never worked in that space. So my understanding of a captive is basically, let's create a little legal insurance entity to carry our own risk, either for our company or for a set of companies that are partnering in some way. Is that about, and then we outsource things like handling.
Yeah, short version for us, you know, as we used to say in the music business, close enough for jazz. Okay, here's the deal. Okay, you have a company. Again, we work with mostly larger mid-market companies. We need to see at least $1 million to $1.5 million annual premium. Once we get there, there are a couple of things that typically happen. Number one, the company has engaged in all sorts of effective risk management tools. And let's suppose they did it 2 or 3 years ago, or maybe longer, and they started to see claims drop. Well, oddly enough, for some strange reason, they're not seeing a solid enough drop in their insurance premiums for it to make sense for them. So they're thinking to themselves, well, why the heck did we do this? You know, we hired a risk manager, we put together manuals, we put together training, we lowered claims, and yet we're not being rewarded. So that's typically the fact pattern that happens. Let me compare that very briefly to a more standard program, okay? Most agents are used to dealing with a non-alternative program, which is 2 things: guaranteed cost insurance with some kind of deductible, okay? So you have, you know, CGL, workers' comp, auto being your prime policy. You around that you sprinkle employment practices, cyber, D&O, whatever. But you buy policies from Travelers or, you know, Cincinnati or Geico or whoever, okay? And then those policies have a deductible, and every policy seems to have like a standard $5,000 deductible, okay? But for most policies, that's fine. That's all you need for most companies, okay? But as you move into riskier industries, as you move into bigger companies, their risk capabilities become more sophisticated. And basically what happened here was that the idea of risk management started in like the 60s, okay? But it started with the big oil companies, and because they had to, right? Well, slowly that knowledge filters down a little bit into mid-market companies. And then it was actually about 20 years ago when you start seeing organizations like the Institutes. They put together the ARM program, the Associate of Risk Management, or the CPCU, which has actually been around a little bit longer. But the idea of risk management became more used and more accepted and more common in mid-market companies, okay? So these companies, they start to put together these programs. And then they start to look at different ways to finance their risk. And that's really where we come in. So as opposed to them going out to their broker and saying, hey, we want to buy a package policy. And that, again, policy, CGL, workers' comp, auto, whatever. We want to take some of that risk onto our income statement in some capacity. By some level of risk, I mean at least $100,000 deductible, maybe $250,000 or $500,000. And the reason why we want to do that is we think we can control our claims to such a degree that we save money. So let's suppose that we're projecting that in year one, we're going to have $500,000 worth of claims. So we buy an insurance program, we take the first layer of risk, $500,000. First year, we have a great year. We only have $200,000 worth of claims. That means that somewhere in the company structure, probably the captive, there's $300,000 of like excess money lying around. Why? Because we budgeted for $500,000 worth of losses, but we were good kids, managed our risk, and now we have $300,000 of savings somewhere in the system. Ultimately, that's what we're trying to accomplish with all of our programs. We create loss-sensitive programs, which means that obviously, you know, if you have a big losses, sorry guys, the savings isn't there. But if you do save, somewhere in the program, money comes back to you in some capacity.
That was a fantastic explanation. Thank you. And now, so I'm a former middle market underwriter. I used to be a middle market underwriter for Liberty for a couple of years.
Okay.
So yeah, in my world, premiums might be higher than $1 million sometimes, and I only did guaranteed cost. Now, my teammates in the big boys in national accounts, they did play in the loss sensitive space.
Yeah.
So if the Liberties and the Travelers of the world, I don't know which other carriers play in the loss sensitive, how's that different from a captive?
With a captive is a financial, it's a company that you form. Okay, so Acme Manufacturing forms Acme Captive, and Acme Manufacturing pays a premium to the captive, and the captive finance or sells insurance to Acme Manufacturing. That only really starts to make sense when you're about a $2.5 million worth of premiums. And the reason why is captives are expensive. That is, okay, you know, you have to seed them with capital and surplus. They have to pay for claims and lawyers and that kind of stuff. So as a result, it's really a bigger company kind of game. Okay, for programs below $2 million, somewhere in the transaction, there's going to be an account somewhere where what we do is we bifurcate the premium. First layer of risk goes to the insured. It's probably going to wind up being at least an accounting entry on the insurance company's balance sheet, and losses. First layer of losses are allocated there. Assuming that they don't tag all of that, some of that comes back to them at the end of the year. Again, if they do have a bad year, again, it's there to fund losses. But for about $2 million or below, we have an account at the insurer specifically dedicated towards the insured. And then if claims go above that, the third party insurance or guaranteed cost kicks in.
Okay. The captives. So once you create a captive, does REcapture also run the captive for us, or you guys
we're a wholesaler
creating a captive?
We're involved with the transaction for about 4 months, ideally. Okay, we get called ideally. Again, this almost never happens in the real world, but we can hope. 3 months before renewal, we get a call from a broker, and a broker says, "Hey, I've got an account. Let's take a look at it." We take a look at it. We say, "Hey, we think we can do something for you. Let's start putting some ideas together." Everything builds up until renewal. We bind coverage. We stick around for about a month after that because there's paperwork to clean up and that type of stuff. But after that, we leave. And the joke I tell brokers, because a lot of times people are like, well, you know, they get worried about losing the account. Dude, the joke I tell them, I don't want to talk to your client. I really don't. Okay. Now we do, because that's part of our job. A big reason why I was brought in is my job is to talk to people about captives and explain alternative risk transfer and that kind of thing. Okay. But the broker is still the client facing guy. The broker still takes him to lunch, goes hunting with him, takes him to sports games. Great. Our job is to make you look good. We have a group of people that we work with, and we have to be very careful here because we don't unendorse or not endorse people. And there's a list of captive managers that we work with. And what we do is say, here's a list. You talk to everybody, you vet them, you find somebody that you like.
We're not endorsing.
Exactly.
We're a yellow book.
Exactly. And REcapture doesn't get any money from that transaction. So if they hire manager A, great. REcapture gets nothing from that. Again, it's a list of people that we work with, that we know, that we've done business with, that we like, but you know, ultimately it's on the insured to make that determination.
Okay. And so I'm sure there are other organizations that can help you create a captive. So what motivated you guys to well, how new is REcapture? Because I know this.
New.
Okay, so you're.
We started. Zach Stock is our president.
Mm-hmm.
He started this about 2 years ago.
Oh, okay.
Here's the weird thing about insurance. Now, I'm also a lawyer, so I'm definitely going to help. Okay, and I used to think that law firms were the most backwards organizations of all time. I used to think that.
That's before you came into insurance.
Exactly. Now they're close to it. They really are. I mean, and they're still backwards in how they're organized. But it's really insurance that's old and outdated. And here's why I say that. You would think that loss-sensitive programs would be perfect for the insurance company. And the reason why is they go to a mid-market company and they say, hey, guess what, dude? You're spending a couple $1 million a year on insurance. We're going to make it so that, structure this so that if you manage your risk, you get some money back. We're there. If it all goes to hell, we have some layer of risk for you. We'll take it, you know, basically acting like an excess layer, for lack of a better term, right? But it's all on you. You would think they would embrace this idea. Why?
It's a win-win. It aligns the incentives.
They're not on the hook. You know, I mean, that's the bottom line. Is the whole funny thing about insurance is that they're like Mikey from the life insurance commercial in the 70s. I don't want to take the risk. You take the risk. No, I don't want to take that. That's the way all insurance companies are, right? For reasons completely unknown, they never really started to embrace this idea. And the reason why they didn't is because they're old-fashioned. You know, their concepts from insurance are hanging out for like 200 years from Lloyd's syndicates, for God's sakes, right? As the market started to harden a couple years ago, the opportunity started to open up. So what Zach did was he started to build his Rolodex of underwriters and insurers that we go to put these particular deals together. And
for the younger brokers out there or underwriters out there, a Rolodex used to hold little business cards. I just dated
myself, didn't I?
I've never seen one. So when people say build a Rolodex, they mean build their iPhone address book.
Yeah, there you go. Yeah, it's funny. I find myself doing that more and more. I date myself like that. When I say Rolodex, I was like, oh my dear God. You know, it's like my wife and I were out last week, and we're at the Greek Festival in Houston, and we see this teenage girl wearing a Clueless movie T-shirt. We both realized the movie was made before she was born.
Yeah, she has no idea.
We both felt, God, I felt old. I was like, oh my dear God, that's a classic movie to you. Oh my God.
Yeah, no, and not only is it a classic movie, she's probably wearing it because it's ironic, and she has no idea.
Yeah, exactly.
The movie. Yeah, exactly. Completely, 100%.
Exactly.
So Zach starts building his
Yeah,
Rolodex.
he starts REcapture, and from our perspective, the market has been really open and accepting to it, and the reason why is that, well, it's hardening market right now, all across the board. Premiums are going up, and it's there's some lines of coverage that are nearly impossible, or it's like pulling teeth getting coverage for. So as a result, companies are like, please, not only are we tired of coming down the wire on renewal, but we're sick of seeing 20% increases in our premium. What can we do about this? Hence, they start looking, and that's when we come in. That's when the idea of putting together a loss-sensitive alternative program really starts to make sense.
So it wasn't. This is not an insurtech play. It wasn't like we have better technology. It's just there's not enough companies that do this well.
Exactly. Yeah. And we offer a complete plug in and play capability for small to mid-sized insurance agencies. If you're with an agency and you've got, like, actually, if you're one agent and you've got big clients, great. If you're like a 10 to 40 person operation or a little bit bigger, and you don't have what we have, we are complete. We can come in, take care of all the brokers in that particular agency. Now you can compete with the big boys and keep your clients who are growing, and you can offer them the solutions that solve the problems that your bigger clients are facing.
Makes sense. Okay. So this is a great way for the medium-sized brokers that are that are trying to go after the big accounts to get their foot in the door at the big accounts.
It's a great way for them. And here's there's two ways that people use this. One, smaller broker, he's got 50 accounts, 4 are really big, and they're his bread and butter accounts. He's always worried about Marsh, AIG, Aon coming in and sniping, right? So he needs an option. So he's looking for something new and exciting and something that really solves those clients' problems. Bring us in. And the reason why is that client has probably read about captives or alternative risk transfer industry magazine or at a conference or a convention, or somebody's mentioned the idea to him in some capacity. So now the broker looks like a rock star because he's bringing up this great idea to the client who already has a little bit of knowledge about it. And then what we do is we come in and treat us like technical closers. That is that, you introduce the client to us. These are the guys that underwrite the deal for you. You still deal with me, the broker, but these are the guys that have been doing it for a long time.
So like the life guy.
Exactly. Yeah, exactly.
Like, hey, I'm still the main contact, but you really need life insurance. Talk to my life guy. He'll help you with that piece.
Exact same thing. Now, the second thing is that now you can go in the door. And here's what we found. The larger companies, the larger insurance companies, larger brokers, there's been so much acquisition that there's a lot of internal turmoil. So you have a company that was with Marsh, right? But Marsh has bought all these agencies. And as a result, internally, they're still trying to figure out who handles what accounts. And we got to divide this office. And we brought this office in. How do we handle all this stuff? We've heard a lot of very concerning issues on the part of clients about the bigger brokerage firms, all centered on service. Phone calls aren't returned. Policies aren't delivered till like 9 months later. Just a level of dissatisfaction. But it stems from the fact that these companies, they're not growing by writing new business, they're growing by acquiring. And when you acquire somebody, your internal organization gets jumbled. Okay. So your small broker, he now has the capability of being the service guy. Okay. He's responsive, he's there on the phone, Guy calls him Saturday at 5 o'clock. Hey, I got a question. I'd love to talk to you. Let me put the game on hold. Okay. That's not happening at the big national brokerage firms. Okay. So he has service on his side. He's got this cool new thing that the client has probably heard of. And he's creating a program once somebody's in a program like this and they really start to see the benefits, because they're being financially rewarded for managing their risk, and there are actual legitimate rewards. You know, company paid $1 million in premium. They had a good year. They had an extra that they, $200,000 came back to them via dividend or savings or some capacity. Trust me, they're not going anywhere else. You know why? Because they cut down one of their biggest expenses on the income statement by 20%.
Yeah, absolutely makes sense.
Yeah.
And so I keep going back to as a former middle market underwriter.
Yeah.
I lost a few accounts to captives, and it drove me crazy because we have no way to compete with it.
Yeah.
Right. We just don't have the tool set. Right. There's no way for me to grab $1 million account and cut 200 grand off of it, right? Or to potentially, right? Even if we're at the same price, but you know what? If you keep your loss under control at the end of the year, you get 200,000 back. I don't have the tools to do that, right? It's not part of the tool set in guaranteed cost. So yeah, it's frustrating for the underwriter, but from the broker perspective, if the account's going to go in that direction eventually, you're much better off being the hero.
If you have an account that's growing, right, and they're growing top line revenue 10, 20, 30% per year, at some point they're going to put together their own art program. Yeah, not a matter of if, but when.
Yeah, you're better off doing it yourself.
You might as well bring it up.
Absolutely.
And at that point, you're the star.
Okay.
You are the leader. You're the thought guy, and they will love you for it. So yeah.
So is the broker the only? And I should have asked you this before we recorded, but is the broker the only client for you, or do you also need reinsurance backing?
Well, okay. For reinsurance, we have all of our contacts.
Okay. So
again, going back to that Rolodex.
Okay. So when it comes to the podcast listeners, brokers are like the ones that are a good fit for you because you've already got your reinsurance back.
Yeah.
Got it. Okay. So is there a minimum size of broker that you're willing to deal with, or as long as they
perspective, it's all about account. It's all account size.
Okay, so if I run a small brokerage, but I happen to have a couple of big whales in my book.
Yep.
Okay. So a one-time deal is good enough for you. You don't need
follow
deals.
Yeah. But as soon as a company gets to about $1 million, $1.5 million in premium, we will take a look at it. We are industry neutral. We're risk neutral. If somebody came to me tomorrow and said, "Hey, I met this guy named Tony Stark who's putting together this artificial intelligence robot army, and he's going to pump billions of dollars into it," I tell you two things: A, we've never underwritten that risk before, but B, we'll take a look at it so long as the premium size is there. Okay. That's all we need to see.
Okay. Here's a dumb question, and I think I know the answer, but just in case, what about, I want to say a captive agent, but I'm saying, what about an exclusive? If there's a State Farm agent out there that is insuring a business that is getting way too big to be with an exclusive, do you guys have a way of working with them, or it just doesn't happen?
Probably not.
I'm guessing,
but that's something that really, in our experience, captive agents, they just don't get to the size.
Yeah. They play commercial at the very small levels. They don't have the tools. Okay. That's what I figured. Okay. So we talked about the type of brokers. The revenue model piece. I just realized when it comes to insurtech, I'm always thinking about the revenue model. So what's the revenue model? Who pays for it? Does the broker pay you, or?
Because we're a wholesaler, we get paid like wholesalers. It's all on commission.
Okay.
Yep.
So from the perspective of the client, and from the perspective of the broker, you're basically a free service.
Yep.
You're getting paid on commission from the ultimate capacity provider.
Correct.
Not on the people that end up running the captive from the
Nope.
capacity providers.
No.
Okay, I had no idea on that one. That's very, very interesting. Okay.
Yeah. And by the way, for your agents, they can still expect to make the same level of revenue from a deal.
Oh, interesting.
Something that clients get nervous about.
Oh, yeah, because the premium's going to be
is I'm going to cut off my nose to spite my face, right?
Yeah.
No, our model, they still make the same payment. So there's no drop in revenue.
Interesting. Okay. They don't need a different license. They don't need like an ENS license or anything weird.
Nope.
Okay. Perfect. So yeah, it's pretty plug and play for the brokers. Okay.
Yeah.
So you helped me build it this year. Come next year, they're very, 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 very likely to stay with me because I saved them money. Do I need you back next year, or am I basically set up for the life of the account?
We come 3 months. I mean, basically around renewal time, for the next year's worth of coverage. So in year one, we put the program together. Year number 2, when underwriting comes around, again, hopefully call us 3 months before renewal. We know that never happens, but please, be kind of nice. And we do the same thing before, put the coverage together and put the program together. And at that point, there may be a need to change some things around. Again, company's gotten bigger or whatever. It gives us the opportunity to look at it with fresh eyes and say, okay, year one, we put, a layer of, deductible of $250,000, a primary layer of $250,000 to $1 million. And then we had a couple layers of excess on top of that. Well, company had a good year. Maybe they can take a bigger deductible. It was $250,000 first year. Maybe they can go up to $500,000 in the second year. Okay. And that would save them on the top line coverage. Again, coming back the second year, we have the opportunity to again, fresh eyes. Maybe there's something new we can do here.
Okay. So I think we've covered the client aspect and the word makes sense and when to give you a call. I will include the link to the company on the show notes, and I will include the link to your LinkedIn.
Please.
So career-wise, go ahead.
Yeah, there's two last things there. One is I've written 2 books on captive insurance. One is called U.S. Captive Insurance Law. 7 people have read it.
7
wrote me 7 and 4 people wrote me specifically and said it cured them of insomnia. So there's that.
Okay.
But for the broker that wants to get more up to date on this, I wrote a book called Captive Insurance in Plain English, 28 pages, PDF format.
Okay, so it's meant for the brokers, not for lawyers.
Exactly. It's written in a very conversational tone. I jokingly call it my People magazine book. Okay, it's supposed to be something you can read, and you're waiting for an airplane. You should be able to bang out the read, and that gives you enough to be conversationally literate. So
okay, so this is basically the tool to help you start the conversation with your client.
Yep, and give that to your client. I mean, it was written for them. If the client's interested, that's specifically meant to be their first read. Okay.
Do you sell that, or is that a free download?
I sell it. It's on Amazon.com. I tell you what, if they're interested in that, have them reach out to me on LinkedIn. I'll send them a free copy.
Okay. Perfect.
Sure.
Perfect. Okay. That's thank you for mentioning that.
Sure.
Real quick before we call it a night, from the career perspective, I do get, so the captives have definitely gotten to a point where they have some cachet. So they have some, they sound cool enough that I get kids calling asking, so hey, I'm an RMI major, starting to work in insurance. How do I move towards the captives? So career wise, there's a designation out there. I can't remember the name. I'll try to find the name. Is it worth it? Is it worth it? And what else would you advise for?
Okay, the answer is yes.
Okay.
I wound up in captives by pure blind dumb luck. I'm in graduate school. I'm getting a master's in taxation. I read a captive insurance case. Before I was a lawyer, I was a bond broker, and I dealt with insurance companies. The idea comes together. You can form an insurance company. Brilliant idea. I get excited. I'm like, one of the only people who would get excited at that prospect, right? So that was when I wrote U.S. Captive Insurance Law, which has been my professional business card for ever since I wrote it. For insurance, for people that are coming up from an insurance, from a career perspective, first of all, risk management is a huge area. Okay, it's kind of new. It really started to pop up, oddly enough, the idea of this after the great financial crisis in 09, 010, when a bunch of portfolios got slammed for exposure to the mortgage market. I'd recommend that they look at getting a designation like what the institutes have, ARM, CPCU, CIC. There's a couple of other organizations, risk management organizations, that have similar stuff. Okay, get one of those. I'd also, if that's what you're really interested in, I would strongly recommend an MBA in finance, because ultimately this comes down to how do you structure, how do you pay for the deal.
Oh, okay. So the numbers are radically important here.
Oh God, yeah.
And the underwriter is the one messing with the numbers. Okay.
Yeah. So ultimately, think about it this way: the corporation is really a series of cash flows, and with finance, what you learn is how to manipulate them and target them. Short version. So
we don't mean manipulating in the bad way. We mean structure them properly.
Exactly. Yeah. Yes. Yeah. Like, and again, insurance is all about, they develop claims, right? Well, year 5, you get the triangle of stuff, right?
Yeah.
Year 1 is going to be 10 grand. Year 2 is going to be 12 grand. How do we finance that? Well, that's where the finance degree really kicks in.
So once you've done that, you've done the education both in finance and in insurance.
Yep.
Then start going to the Vermont.
Vermont's a big one. Well, okay, yeah. If you're really interested in captives, what I'd recommend is that get an insurance license, but make sure you have the personal ability to prospect large accounts. This is not a small guy game. Again, we've gotten the level down to about $1 million, $1.5 million in premium. Below that, the company doesn't have the financial girth to fund their own insurance program. But there are plenty of companies out there that are big enough that need this particular type of solution. What you need is the ability to somehow get in the door. So that's where sales and marketing come in.
Okay, perfect. So anything that gets you into the national accounts, to get you to play at that level, whether that means going through one of the big brokers and learning the game there, or whether that means at least becoming a national accounts underwriter and then learn how to bring them in the door. Okay, I got the general idea. Fantastic. Thing was that the question comes up and I never know what to say on that one.
Well, it's a very new area.
That's interesting. I had no idea that before 2009 they were not popular.
Yeah.
So yeah, that is for insurance. Like the only thing within insurance that is newer than that, or from around the same time frame, is cyber. Yeah. Like basically everything else is much older than that.
Yeah, pretty much.
Okay, so truly cutting edge when it comes to actual insurance, not the tech side of insurance.
Exactly.
Yep. Very, very cool. Very cool. Well, I have definitely learned more about captives today than the last 10 years of my insurance career, or 11 years.
There you go. I've done my job.
So thank you very much. Definitely a great episode. And yeah, I will link the ebooks, your LinkedIn and the company's website, and brokers who are still listening this late in the episode. Don't lose your big accounts to the natural process of a better risk management strategy. You can play with the big boys by helping them yourself to create a captive.
That's it.
Awesome. Thank you very much for your time.
Take care, Tony.
Awesome.